So we continue with this terrific tax discussion. I can't believe I'm excited about this, but I am. With Tim Cestnick. I told Tim when we started this week that it was like reading Russian to me initially, but now it's starting to really become clear. He is a chartered accountant. He is the president and CEO of the WaterStreet Group Incorporated. And he's also the author of this terrific book, 101 Tax Secrets for Canadian Smart Strategies that can save you thousands. So we're talking about pillars for tax planning. Over the last few days we've talked, yesterday we talked about dividing. The day before that we talked about deducting. And today we're talking about deferring.
The 4 Ds. Yeah.
So they're all Ds. You're like a good preacher. Alliterative to the max. So what are we talking about with deferring?
Deferring your tax liability is the idea of moving taxes that would otherwise have to be paid today, moving to a future year. Now the value of that is what we call the time value of money. If I have $100 in my pocket today and I don't have to give it away and I can use it for the next year or 2 years or 3 years or 4 years, I'm going to be able to benefit from that because I can earn income on that $100. So there's a value to having the money in my hands versus giving it to the government too early. So deferring is the idea of putting together some strategies that will allow you to push a tax bill off to a future year. Some people say, well, you know, I'm going to pay it eventually, so what's the value? But again, it comes down to having that use of that money in the meantime. So there are all kinds of ways to defer, and probably the most obvious way that we can defer tax, and every Canadian should be doing this if they can, and that is putting aside money in an RRSP. A registered retirement savings plan. Right. How does that defer tax? Well, you put money in today, say it's $10,000, you get a tax deduction today, so you're not paying tax on that $10,000 today. You're paying tax later in life when you pull it out in retirement. So you're deferring actually potentially for 20, 30, 40 years, depending on your age. So it's probably the most obvious way Canadians can defer tax, and many Canadians have not yet maximize their RSP contributions. They don't put money in every year. And some people say, well, I just haven't got the cash. You know, where do I get the money from? And I would encourage you to be creative about that, because there are ways to get the money to put into your RSPs. You could go out and borrow money to do that. That's one method of doing it. But there are other things that can be done as well, which we can talk about. But it really, getting the money in the plan is the #1 obligation.
And by the way, the concept of borrowing to put money into an RSP is a pretty good one, because if you say using that $10,000 figure, say you put in $10,000, that really impacts your tax return, right?
It does.
And then you can, if you want, almost pay the whole thing off immediately.
That's right. If you borrow, say, $10,000 to get caught up on your RSP contributions, you're going to get back anywhere from, you know, $3,000 to $4,600 in taxes or in tax savings. Mm-hmm. That money can be paid against the loan, so it reduces the amount of the loan that's still outstanding. And then you can pay down the rest over even a period. Even if you pay it off over 3 or 4 years, it still makes sense.
It's like forced savings in a sense.
It is. It's exactly what it is.
Yeah.
And some people, you know, in order to save, they have to be forced to save. It depends how disciplined you are about doing that. So that's an important thing to think about. The other thing that RSP contributions do, by the way, is they not only provide you cash in the form of tax savings, which often come back as a tax refund. You can use that for paying down your debt, or take that cash and contribute to, say, another plan, like a registered education savings plan, an RESP.
That's for your kids.
Yeah, and that's the second way to defer tax, by the way. Put the money into a registered education savings plan, because you're going to earn income inside that plan for your children to go to school one day, or your grandchildren, but you're not going to pay any tax on that income over those years, not until the money comes out of the plan. So we're deferring tax until a later date. And also, when the money comes out of the plan later, you're not paying the tax, it's the student that pays the tax. And quite often, students aren't going to pay any tax. They don't have enough income. So not only are you deferring tax, you're actually potentially eliminating the tax as well. So take your tax savings from your RSP contribution. Maybe the tax savings are $3,000 to $4,600. Put $2,500 into an RESP for a child, and you've done both things now. But I also want to tell people this. I think that your first priority should be saving for your own retirement. Even over saving for a child's education, because there are different ways to pay for a child's education. That's a topic for another day, but there's, you know, there's begging, borrowing, stealing, sweating, and saving to pay for a kid's education, and that's a topic for another day. But your retirement savings come first. So that's the best way to defer. And maybe the last way to defer tax is very simple. When you're thinking about selling an investment and it's going to create a tax liability, think twice about it. Ask yourself the question, do I have to sell this today? Can I push this sale off to next year or the year after that? Because just by doing that, you're going to defer the tax.
When you mean selling an investment, you mean selling some financial investment?
Could be a stock, could be a bond, could be a
see.
mutual fund.
Right.
You know, you want to push that off to a future year if you can, because you don't want to pay the tax today if you don't have to.
Because when you sell it, you got to pay taxes right away.
Yeah, if you sell it at a profit, you do.
Right.
Now, there may be reasons why you might want to sell it anyway, because you think the future of the investment looks bleak or whatever. So don't be dumb about this. If you think it's time to sell, then sell. But if there's a way to defer the tax, think about it.
Okay, the book is called 101 Tax Secrets for Canadians, Smart Strategies That Can Save You Thousands. We'd like to make it available to you friends. We have a limited supply, and you can phone or you can log on to the website. One or the other. This is not a write-in offer simply because the number is so limited and our time is short. We don't want you to be disappointed, so get to your phone or get to the computer ASAP and ask for the book, and remember to give us your best ministry offering. We really are supported by you, and you know that. We don't sell commercials. We basically are there just supported by people who believe in what we're doing, and we'd be delighted to get the book out to you right away. Thanks for